how to choose an investing strategy for beginners. So this is StockerFinance. I'm your host, David Scheuer. All right, so first off, you got to decide what you want. Do you want a fast return? Do you want long-term wealth creation? Do you want consistent income? Do you want to just keep your money safe? Well, with each of these decisions, there's also a catch, and there is a catch to every strategy. So do you want a fast return? Well, that means more risk. Do you want long-term wealth creation? Well, it takes a long time. Do you want income? Well, you're going to need capital. Do you just want to keep your money safe? That means a lower return. So here are the most popular strategies. This includes value investing, dividend investing, growth investing, etc. And I'm going to talk about each one of these as well as my own personal strategy in this video. First off, let's start with value investing. Value investing is an investment strategy that involves picking stocks that appear to be trading for less than their intrinsic value. Value investors actively seek out stocks they think the stock market is underestimating. Intrinsic value basically means that you're trying to find a stock that is less than what you think it's worth. So let me break this down for people who don't understand what that really means or what the word intrinsic means or what the word intrinsic value means. So essentially, you are thinking that this stock is worth less than what a future value of the stock is in your opinion. So if you have a stock worth $10, you think the stock is actually worth $20 for whatever reason. The $20 is its intrinsic value. The tricky part here is figuring out what is that intrinsic value? What's the number? What is the potential future value of this company? Is it less than what the stock price is right now? Is it more? Is it about the same? What is it, and how do you decide that? Well, you decide that by doing research, by looking at balance sheets, looking at the profit of the company, like PE ratios, looking at dividends, looking at, the products they're going to be releasing in the future, or just how much the company is worth in general and how much you think it's going to be worth in the future. And it's really tricky to figure that out, but if you can understand value and what intrinsic value really is, then you're going to be a great value investor. So Warren Buffett is one of the most famous value investors there is. And some pros are long-term wealth creation, potentially high returns. It's a buy and hold strategy, and it can go along well with other investing strategies. It's effective and a simple strategy. Some cons are that it requires lots of patience. Situations can always change. It can be hard to find undervalued stocks. There's no room for emotion, and intrinsic values can be extremely difficult to estimate. You're just using your own opinion, and it's really easy to just go see someone else's opinion about an intrinsic value of a stock and then have them be wrong or have your own opinion be wrong. So it's really important to do an insane amount of research when value investing and understanding what intrinsic value really means and understanding, the fundamentals of the company or the potential future value of the company based on new product releases, based on consumer behavior, etc. So value investing is a great strategy, and it's one of the most famous strategies for investing. Another kind of famous strategy that a lot of people may know is dividend investing. Dividend investing is a strategy of buying stocks that pay dividends in order to receive a regular income from your investments. This income is in addition to any growth that your portfolio experiences as the stock gains value. So Joseph Carlson, a fellow YouTuber, is a dividend investor. And if you want to learn more about what dividend investing really is, I highly suggest you go watch some of Joseph Carlson's videos. He's a great YouTuber. He kind of has a podcast-style YouTube channel where he talks about recent news as well as dividend investing and his personal account. So if you want to learn about dividend investing, I suggest watching his videos. Some pros are long-term wealth creation. It creates consistent income, buy and hold. Growth of companies can also complement the dividends that you're receiving, and compound interest. As you reinvest these dividends, or if you choose to reinvest these dividends, it'll create compound interest that'll grow extremely quickly over time. So, cons, it requires patience. Dividends can change. Companies' value can decrease. There's no room for emotion. It takes a lot of capital to really receive a substantial income. Even if you have $100,000, you may not be receiving a massive amount of, worth of dividends every month or every, quarter or whatever it may be. So you really need a lot of capital to be receiving a substantial income. But as as compound interest does its thing, if you keep reinvesting dividends, that's only going to grow, and over time it'll grow quicker and quicker, and you're going to be eventually, gaining a substantial amount of dividends, but it does take a lot of time and requires a lot of patience. So next up is growth investing. This is a more aggressive strategy than the last two. Growth investing is an investment style and strategy that is focused on increasing an investor's capital. Growth investors typically invest in growth stocks. That is, younger small companies whose earnings are expected to increase at an above average rate compared to their industry sector or the overall market. George Soros could be considered a growth investor, as well as a lot of other investors. Some pros to growth investing are it's a long-term wealth creation, and you've kind of seen that as a similar pattern. Everything's really about long-term wealth creation. Potentially higher returns than the other strategies, more active trading, faster growth, and just beating the market overall. Some cons to it are it does some require some patience. It's higher risk, very volatile. Again, no room for emotion. If you get emotional, you might want to go with a strategy more like buy and hold, which I'm going to talk about in a second. Growth investing can be extremely volatile as you're investing in a lot of companies that have recently IPO'd or that whose stock prices aren't, that established yet, and that are their market maybe smaller cap companies, which may be extremely more volatile than larger cap companies. And it can be hard to find great growth companies. Generally, when you're finding a growth company, unless you choose a more, solidified company that's already considered a growth company, but it's not going to get as crazy of a return as maybe a brand new Amazon or Netflix when it first came out, or Tesla, etc., whatever it may be, that you want to consider a growth company, it can be hard to decide what that is. So next up is buy and hold, one of the most simple strategies of all time, and also an extremely effective strategy. Also called position trading, is an investment strategy where an investor buys stocks and holds them for a long time. That's all there is to it. Extremely straightforward. And the goal is that the stocks will gradually increase in value over a long period of time. Benjamin Graham is a growth investor, so is Warren Buffett, but they're also value investors, and they're also, in a way, especially Warren Buffett, dividend investors. So some pros to this is long-term wealth creation, hopefully kind of consistent returns as you just buy and hold it and let it ride out. After 20 years or so, you're going to get an average of whatever it may be return. Diversified, or not diversified, you don't have to be, but that is a pro too, is that you can be diversified if you want to, and that goes along with pretty much all of these. You don't have to be, you're not worried about the market fluctuations, so that's a big pro to this. For people who get emotional and see market fluctuations, you don't even have to look at your account. You can just let it sit there, hold over a long period of time. No need to worry about, the dips and the daily fluctuations then and there. And it applies to almost every sector. So some cons to this is it requires a lot of patience. It's going to take years for this really to grow substantially, unless, you're buying and holding a growth company or a company that you believe will be growing substantially faster, or if you apply this to value investing as well, just buy and hold, and, maybe you'll gain a faster return. But generally, it requires a lot of patience. Generally, I put lower average returns on there. That definitely probably shouldn't be on there because buying and holding can result in massive returns. But also, buying and holding tends to mean, for some people, being extremely diversified and just buying and holding into more boring stocks and just letting them ride it out. And that can, not be as great of returns as a higher risk situation, but buying and holding can still be higher risk depending on the company that you are buying and holding. So lower average returns is not necessarily a con there, but it can be. That probably shouldn't be on there, to be honest. Very volatile. Now, buying and holding is not very volatile because you are simply buying and then holding for long periods of time, but the market can be extremely volatile, and you have to be able to stomach that. So you have to stomach the downturns, and it's kind of a boring investing strategy. You're just buying once and then holding for a long time. You're not really doing anything else. You're not actively trading it. You're not really adjusting your account very much. You're just buying a company or a collection of companies or assets that you believe in and then holding them for a long period of time. So it can be kind of boring for some people who want to be more active investors. Next, for our active investors and for people who want to make a higher return in a shorter amount of time, we have high risk, high reward investing. High risk investment is therefore one where the chances of underperformance or of some or all of the investment being lost are higher than average. These investment opportunities often offer investors the potential for much larger returns in exchange for accepting an associated level of risk. Michael Burry from The Big Short, he could be known as a high risk, high reward investor, especially around his, mega trade, his multi-billion-dollar trade of shorting the stock market. That was a very high risk, high reward investment, aka bet. So, that's the one thing with high risk, high reward investing is there's a big difference between investing and gambling, and a lot of people don't define that difference, and they end up losing all their money by just gambling on the stock market and not doing actual investing. So if you're going to make a high risk, high reward trade or high risk, high reward long-term investment, make sure to do your research, do your investigating, and really figure out and be confident about the position you're taking, because you have to remember the high risk part is still there. Even though there's a potential high reward, a lot of times the risk can outweigh the reward, and you really have to try to balance that correctly. So pros: long-term wealth creation. And that's pretty much, you've seen that on every single one here, because all the goals of every single strategy is really to create wealth in the long term. Some are in the shorter term, but even with Michael Burry, he had to wait a pretty significant amount of time before he got that return. So it is a long-term wealth creation strategy. Every single one of these is. And, people might have different opinions on it, but I think so. At least that's the goal of them. So potentially large returns, seeking out opportunities, takes advantage of market fluctuation. So unlike buying and hold, you're really taking advantage of different situations. And it's for shorter periods of time, so you don't have to be as patient as you may have to be with others. It's extremely high risk, though. These are some of the cons. It's very volatile, and you have to have no emotion when this. You really have to stomach out different losses. Michael Burry had to stomach it out for a long time. In fact, he had to stomach it out so much, he actually lost a pretty significant amount of clients. He lost friends. He had people mad at him. And if you watch the movie, you see that, or if you read the book as well, it portrays that even more. So it's a very risky situation, and you really have to have the stomach and the gut and just be confident enough in your position to want to hold that out and to not exit your position too early or whatever it may be. And you do have to have some patience. I know I said you don't have to have as much patience as others, but you have to have patience depending on the investment you're making. Just like Michael Burry, if he didn't stomach out, if he didn't have the patience, he could have ended his position earlier, would have ended with a huge loss, and missed out on a massive opportunity. And there's extreme uncertainty, especially just how much risk is involved in high risk, high reward investing. So now this is my personal strategy, and I'm just giving this as an example because I combine multiple different strategies, and this is what you should do as well. So I call it the triple threat strategy, and you can watch a video on this to go more in depth to it. But an investing strategy that combines value investing, growth investing, and high risk, high reward investing all into one. It's a triple threat. Investors seek out larger returns in shorter periods of time, but make bets on companies that they are okay with holding for long periods of time. So I am a triple threat strategy investor. Some pros to this are long-term wealth creation, potentially large returns. Its goal is to beat the market average, lower risk than high risk, high reward, and for shorter periods of time. It has higher risk, though, than just buying and holding, or also, just simply buying and holding a company, since it's a little more active trading involved. It's very volatile. You can't have emotion involved in it. You need to be patient. And sometimes my account personally isn't extremely diversified. Warren Buffett I would consider to be pretty diversified. Same with other investors that I've talked about in this video. But my account is not particularly invested or diversified. But I am focused on companies that I think have massive growth potential, that I think are currently undervalued. And they still have some high risk involved with that, whereas high risk, high reward comes into play there. So this is just my personal strategy. If you want to know more about it, go ahead and watch that video. I'll throw a link up somewhere. So which one should you choose? Well, as I said, it's all up to your risk tolerance. Make sure to ask those questions that you saw at the beginning of the video and decide what your long-term goals are. And you can/should combine more than one strategy. I just explained the most popular strategies here, but there's tons of different strategies out there that you can learn about. I suggest if you want to learn more, go to Investopedia, watch YouTubers. Although be careful with some YouTubers, since a lot of them are extremely opinionated and not based off just facts. So I suggest going to Investopedia. The Motley Fool can sometimes help as well. I trust them a decent amount. Be careful where you get your information from. Read books as well. There's a lot of great books, and I probably trust books the most out of any information source out there, besides probably Investopedia, since it's basically just a dictionary, or encyclopedia, I mean. An example is, Warren Buffett, who combines dividend investing, value investing, and buy/hold investing. He typically finds companies that are undervalued with the value investing strategy, then buys them, then holds for long periods of time. And generally, he wants these companies to have a dividend that he's receiving as well, so he can keep reinvesting his dividends. And that's how he's become so wealthy. He obviously did it on a much larger scale than most people. He started with a pretty significant amount of money. But in the long term, he kept compounding. And the value investing strategy, as companies went towards that intrinsic value, he also compounded on that by reinvesting the dividends. And he just rode out all of the fluctuations, didn't panic. He never, sold too early, really. Although he had some mistakes, he still, just bought and hold for long periods of time. I believe he still even owns Coca-Cola. He still owns plenty of the companies. There's a lot of positions he's never sold out of from buying, because he's just so happy with receiving the dividend and from it heading towards that intrinsic value. All right, so thank you for watching so much. Make sure to subscribe and like. Check these videos out as well. Make sure to follow me on Twitter at StockerFinance, and comment below any questions. What is your strategy? If you have any questions about strategies in investing or how to get started, go ahead and check out some of my other videos, and I'll respond to pretty much any comment that is asked below. And yeah, I'll see you guys in the next video. Peace out.